Welcome and thanks for joining this brief investment insight video. I'm Ross Bramwell, a member of Hamrick investment team, and today I'll be discussing a few key considerations that we want you to remember about our bond portfolios, especially in today's rising rate environment. There are four key considerations that we'll cover. First, when you look at a paper custodial statement, if you get it in the mail or an online view, when you log in, it's important to understand that those statements reflect today's market value and the cost basis. But they do not reflect performance, as income that has been received is typically not included. We'll discuss that the total return of your personal performance is made up of two components. Your total return equals the yield, or income distributed, plus or minus any changes in price over time, which is what we'll call the unrealized gains or losses. Second, last year was an unprecedented year for bond performance, so we'll try to put that in context when looking at longer-term performance. Third, current bond portfolios, if bonds are purchased below their par value, may offer price appreciation as well as the yield you can collect along the way. And last, that diversification in bonds matters just as much as in equities, and that diversifying duration risk is one way to maintain a key objective of bonds, which is capital preservation. On a standard custodial statement, or when looking online at your account, you will typically see similar columns to what I am showing here. You'll see the mutual fund ticker or ETF symbol. You'll see the name of the fund. You'll see the quantity of shares that you've purchased over time. You'll see the current price, so that's today's market value. And then you'll see your total market value, which is just your quantity times the price. And then you'll see your cost basis, which is the aggregation of all the shares that you've purchased over time, whether you've reinvested the dividends or maybe you've bought multiple times. Then you'll have your unrealized gain or loss. This is just your market value plus or minus your cost basis. Typically online, you can go a little bit deeper and see the different lots of shares that you have purchased over time. That's what we see below. Or maybe if you were reinvesting the distributions. In this example I created here, the bottom chart is just a snippet of an example of different lots which show up the aggregate lines that we see above. But you'll see it has the same information: quantity, the current share price, the cost per share as of the date that you bought it, and then today's market value, the cost basis, and then again the gain or loss for each share. The main point, though, that I want to make is that the current value reflects all of the shares at today's price, and that the cost basis is the aggregate cost to purchase those shares. In fixed income, like in today's environment when rates are rising, it may be more common to see an unrealized loss as bond prices go down when yields go up. So here we show an unrealized loss due to decreasing prices. Remember, though, if we had an individual bond and just held it to maturity, I'd still get back the par value even if the prices go up and down while I hold it. But what you may also notice is that there is no column for income received here. Those distributions may just be going to cash to be reallocated elsewhere. So looking at the market value versus cost basis is just part of the return picture. Remember, your total return equals the price return, which is showed here, the unrealized gain or loss, but also the income component, which is not included here, but is reflected in Hamrick's reporting system, where we record income transactions and have performance over different time periods, such as year to date, 1 year or longer, or by specific year. Next, I just want to highlight what this chart shows clearly is how unprecedented the returns were in general for bonds last year. Typically, when equity markets are down like they were last year, bonds may become a safe haven. And as capital moves to a typically safer asset classes, and prices would go down as yields also go down because of more demand for bonds. But last year was different. Stocks went down as yields rose quickly as the Fed hiked short-term rates. This created tremendous losses for parts of the bond asset class. As you see, the Bloomberg Barclays U.S. Bond Aggregate Index was down almost 17% at one point last year and ended the year down around 13%. Last year was clearly the outlier from prior years. Tying into our first slide, although bonds were still paying a yield last year, the price depreciation more than offset any income received, and there was an unrealized loss. This performance will drag down all longer-term performance when comparing or reviewing bond portfolios and managers. So it's important to look at the future potential return and strategies. Looking forward, we can generate yields today in many cash and bond strategies that we haven't seen in almost 20 years, which gives us more alternatives in constructing portfolios. Next, quickly, I just want to highlight one of the opportunities that we are seeing in today's markets with some of our active managers. Given the rising rate environment, as we've discussed, many bonds are priced lower, and sometimes those are now below what we'll call par value. Par value is the value an investor will receive if the bond is held to maturity. So active managers may be able to buy bonds at a value of, let's say, an example of $90, and par value is $100. If the manager holds that to maturity, the manager will receive $100, even though he bought it for $90. The manager will also receive the income distributions for the time the bond is held. Having a portfolio priced below par value allows for the potential upside of price appreciation of getting that extra $10 over, let's say, the next 3 to 5 years until the maturity is, as well as the return yield while holding the bond. So an investor can receive a higher return than just the yield. We believe there's a potential opportunity to achieve this in today's environment with successful active management. Finally, I just want to reiterate the point that diversification matters with bonds. It matters just as much with bonds as it does with equity in managing risk. With the Fed's unprecedented rate hiking cycle since March of 2022, the yield curve has been inverted for quite some time, with short-term yields at very attractive rates. We'll see on the far left-hand side in the 3-month, 6-month, 1-year Treasury yields, even if 5% or higher, while longer-term yields have also been rising in recent weeks. We believe it makes a lot of sense for investors to hold within their bond allocations exposure to short-term bonds and collect the higher attractive yield, which we are currently doing. But we also think it makes sense to have exposure to managers that have more duration as the Fed is closer to ending its hiking cycle and given the elevated risk of an economic slowdown over the next year. We believe we can still collect an attractive yield, but have the additional potential for price appreciation if yields were to decline. But that will depend on what the Fed ultimately does. Given the uncertainty of how high the Fed will ultimately hike and for how long they will stay there, we believe diversification without sacrificing the yield component makes a lot of sense right now. Thanks again for watching this video. If you have any further questions, please reach out to a member of your client service team. Thanks again.